Have you ever wondered why companies sometimes borrow money and other times sell the shares? This choice between debt and equity has shaped the economies for thousands of years. And here's the thing, it's not just for big corporations. Understanding debt and equity help us in our everyday lives, whether it's buying a home or starting a business or investing for retirement. Hi, my name is Rushit and welcome to my channel. Here, I make personal finance and wealth management concepts simpler for you. Today, we'll deep dive into debt versus equity. By the end of this video, you will understand what they are, how they are evolved through history, and how they affect your financial decisions in day-to-day life. So let's start. Debt is when a person or a company or even a government borrows money and promises to repay it back to you, usually with interest. Think of it like a contract. It gives you money today and promise you to return it tomorrow with little bit extra for the risk they are taking. You probably use that in everyday life. Like if you have taken a student loan, a mortgage for a house, or even swiped a credit card, that's a debt. In all of these cases, you don't just give up your ownership. You owe them money back and to whoever's lend you that money. So let's start. Debt is when a person or a company or even a government borrows money with the promise that they will pay you back, usually with the interest. Think of it like a contract. It gives you money today and you promise it to return it tomorrow with little extra for the risk they are taking. You probably use that in everyday life, like when you're buying a home, you take a mortgage. When you take a student loan, you're taking a loan from a government or a private institution. Or when you are swiping a credit card, that's also a debt. In all of these cases, you just don't give up your ownership. Like you just owe back some money to them which they have lended to you. Businesses use debt too. Imagine a small coffee company where they want to expand their business and they need 100,000. So they will go to the bank or a private lender and they will borrow the money for fixed term at a fixed rate or a variable rate. It depends. At the end of the term, the company pays back the bank $100,000 and at every fixed decided term, they pay the interest to the bank for the risk the bank is taking to lend them the money. Companies like Apple, Amazon, or any other big 500 companies, they borrow the money in the same way but on a larger scale. They issue something called as bond to the investor, and the investor buys the bond from the company, and at the end of every fixed term, the company pays the investor something called as coupon. That's the interest, and that's for the risk the investor is taking to lend the money to the company. Government also rely heavily on debts. For example, they will issue a treasury bond to pay for things like infrastructure, healthcare, defense, and it all depends on the use of the money. The government will issue such kind of a bond, fixed, variable, and many more. During World War II, US and Canada sold war bonds so ordinary citizens could lend them the money to support in their war efforts. The key thing about debt is that ownership does not change. The lender does not run your business, they just want their money back. Debt payments are fixed and predictable, which is good and bad. Good because you know what they expect, and often businesses can deduct their interest payment from their taxes. Bad because they have to pay the money back. If you don't pay the money back, you are defaulted and you go bankrupt. The same thing happened to Lehman Brothers in 2008. They were overloaded with debt and they did not have any money to pay it back, and it triggered a global financial crisis that we all know in 2008. Now let's talk about equity. Equity is different. It's ownership. When you put money into the business for exchange of shares, you are not just lending the money, you are becoming a co-partner or a co-owner. Imagine you and your friend is starting a food company and you put in 70% of the money and your friend puts in 30%. And then you are a co-owner now and you share the profits, you share the risk, and it depends on what the terms you have drafted. But that's equity. Companies use equity to raise money all the time. When Shopify, a Canadian company, went public, it sold the shares to the investors on stock market. Investor bought the shares, which gave Shopify money to expand, and in return, those investors become the part owner. If you ever watch Shark Tank or Dragon Dance, you see this in action, where company comes in, the founder pitches an idea, and he's probably raising 100,000 for 10% or 20%. So that's equity financing. They are trading ownership for investment. The defining feature of equity is that investors share the risk and reward. If the business fails, investors lose their money. But if the business succeeds, the value of the share can skyrocket. Jeff Bezos started Amazon in 1994 and with a small amount, and he raised the money from his friends and families. And years later, that shares are now valued in millions and billions. So that the risk their family and friend took for Jeff Bezos, and they got the reward. On the opposite side, selling ownership also means selling the control. At WeWork, for example, WeWork, the founder Adam Newman lost much of his influence just by selling too much equity to their investors, and he lost the control over the company. Debt and equity have a long, fascinating histories. Debt goes back thousands of years. And in ancient era, as far back as like 2000 BC, farmers used to borrow money for plantation and return it back after they harvest their grains. So these transactions were recorded in a clay tablet, and these were the first contracts in the history. In medieval Europe, kings borrow money from merchants to fund the wars. If king did not pay back, it could destroy the merchant's entire fortune. In modern era, it become more structured. Government and company issue bonds. Like during World War II, bonds were issued to fund the wars. Debt is always about trust, the promise that you can borrow today and will be returned tomorrow. Equity, on the other hand, came later but completely changed the game. Dutch East India Company in 1602 became the first company to issue the shares to the public, creating Amsterdam Stock Exchange. People could invest in voyages to Asia, share the profit, and then even resell the shares. This was revolutionary because it allowed ordinary people, not just kings or the wealthy people, but the ordinary people to invest in massive projects. Britain followed with the London Stock Exchange, and equity financing helped fund the Industrial Revolution. Railways, factories, ship equipments, ship companies. In modern times, stock exchanges like New York Stock Exchange and Nasdaq have become the heart of capitalism, with trillions of dollars traded daily. Now let's compare debt and equity side by side. With debt, you keep full control of your business. Payments are predictable and interest can be tax deductible. But you must to repay the money no matter what. And too much debt can also sink you. That's bankruptcy. With equity, there is no obligation to pay to investors, but they share the risk with you, and sometimes they even bring expertise and networks. But you give up the ownership. You share the profits forever. Investor can pressure you into making decisions, and that might not be what you want. The easiest way to remember this is to think like debt is renting money. You borrow it, you use it, and pay it back with a fee. While equity is like investing in a roommate, where they chip in with the cash and share the expenses, but now they have a say in how things run. You might be wondering, okay, but I am not starting a $1 billion company. Why does this matter to me? This is true. You already deal with debt and equity every day. When you buy stocks in Apple, Tesla, or Shopify, you're buying a equity, you're becoming a small part owner every time you buy a share. When you buy a bond, whether government bond or issued by a corporate, you are lending money to the corporates. You are an investor for them. When you buy a bond, you are trying to buy a debt. You are lending money in exchange for an interest. In your personal life, a mortgage is a debt, while you're owning the home is equity. Starting a side hustle with a partner is equity too. Understanding the balance between debt and equity can help you make smarter financial decisions. Choice for borrowing, investing, and building wealth. So, debt versus equity, two different powerful ways to raise money. Debt is about responsibility and repayment. Equity is about sharing ownership and risk. Both have fueled progress from ancient farms to biggest tech companies today. Now, I would love to hear from you. If you're starting a business today, would you prefer equity or debt? Would you prefer keeping control by borrowing money, or would you like to give up some ownership by lowering the risk? Drop the answers in comments below. I would love to hear them. If you find this video useful, please like and subscribe. I will be posting more financial content. Thanks for watching. Bye.